Well, I have 1 o'clock, so welcome to everyone. Maybe we will get started. My name is Lynn McGrade, and I'm pleased to welcome you here today to BLG's session on ESG expectations of institutional investors. I'm a partner in our investment management group in the Toronto office, and with my fellow partner, Ravi Latour, who's a partner in our Calgary office, we're very pleased to be here today and very pleased to be joined on our panel by two representatives of two of the world's leading ESG investors. And that's BlackRock, of course, and RBC Global Asset Management. And as some of you may know, they're a great fit together, these two, because they actually have a joint venture in Canada. And you can look for ESG investing strategies for your own portfolios when you look at their lineup of RBC iShares funds. So it's really great to be joined with them today. And I'll just do a brief introduction for everyone. So first, I'd like to introduce Melanie Adams. Melanie is the Vice President and Head Corporate Governance and Responsible Investment for RBC Global Asset Management. And she's a member of the leadership committee there as well. Her team supports RBC GAM's investment teams in integrating environmental, social, and governance factors into the investment process. She engages in active stewardship, and her team provides meaningful client reporting on responsible investing. So welcome today, Melanie. We're very pleased to have you. I'll also like to introduce Michelle Edkins, who's Managing Director in BlackRock's investment stewardship team of over 60 specialists covering the Americas, Europe, the Middle East, and Africa, and Asia Pacific. And in that role, she's responsible globally for institutional relations, policy on investment stewardship issues, and communications related to BlackRock's investment stewardship perspectives and activities. She also serves on the firm's Global Operating and Government Relations Steering Committee and is an active participant in public corporate governance debate. She was named in the NACD Directorship 100 Governance Professionals list in the past 7 years. So we're very excited to hear what they have to tell us about today. And as I mentioned, Ravi Latour is joining me. He's a partner in our Securities and Capital Markets group in our Calgary office. And Ravi spends a lot of his time advising issuers and investors who are trying to complete transactions while focusing on the ESG risks and managing those risks in a way that is successful from both the investment side and the issuer side. And prior to this session, we did ask people to submit questions. We received a lot of questions for which we thank you very much. And we're going to really direct our remarks around the questions we received. I don't think we'll have time for live questions here, but hopefully the questions we received in advance are going to be representative of some of the things you've been thinking about. So Michelle, I'm going to start with you. And, we did have a number of questions that related to how investors are viewing ESG from an investment perspective. And someone asked, how do investors balance the desire to move immediately while recognizing that it may take time to actually unwind decades of legacy process? Someone also asked, to what extent are investor values driving investment valuation? And have institutional investors really lost sight of the basics of ROI and analytics? Someone asked, to what extent can other key investment factors like best execution be compromised to achieve ESG principles? So, Michelle, how integral are ESG factors in BlackRock's investment decisions? And have you ever walked away, has a BlackRock ever walked away from an otherwise strong investment opportunity due to poor ESG factors or reporting? And how do you put all these competing factors together as part of your overall ESG investment philosophy at BlackRock?
Thanks, Lynn, and hello, everybody. Thanks for the opportunity to cover these issues here today. I think I'd like to start by saying that in many ways, we believe that ESG is something of a misnomer. We think the governance component has to come first, in the sense that high quality leadership demonstrated by the board and executive management is going to be key to a company addressing the material, environmental, and social factors that are part of its business model. Many of you may be aware that at the beginning of last year, our CEO, Larry Fink, wrote a letter to the CEOs of the public companies that we invest in. And we also wrote to our clients, making clear that in response to client demand and expectations, we were making sustainability core to everything we do for clients. And really, when we talk about sustainability, we're talking about the E and the S in the ESG. And for us as an asset manager on behalf of our clients, there are three key ways that we are doing this. The first is in the range of products offered to our clients. As many of you may know, BlackRock has a significant portfolio that is invested through index strategies. And so it is incredibly important for our clients who want to invest on a sustainable basis to have a range of opportunities to do that in that index suite of products. But we're also looking to innovate on the active side in terms of offering thematic active funds for clients who have views on that side of the investment spectrum. The other component, or what means that we integrate sustainability, is through those active investment strategies. And we have introduced systematically across all of the active strategies, whether it's in equity, whether it's in fixed income and credit, or whether it's in real assets and private equity, an approach to integrating material sustainability factors into our analysis and investment decision making. For a lot of that type of decision, we're really looking at the risk profile of a company in relation to its sustainability profile. Increasingly, though, there is the data available to look at the opportunity set on the sustainability side as companies innovate and adapt their business models. Importantly, for this process inside of BlackRock, this ESG data and the insights go into the investment and risk management platform that is used across the firm. It's called Aladdin. And so this is information that's available to every investor in the firm and is part of their process, as I mentioned. The third way we integrate sustainability factors for our clients is through the work of my team, investment stewardship. And investment stewardship is principally responsible for having the conversations with the public companies that we invest in on behalf of our clients, to ask them about the quality of their leadership, to ask them about the resilience of their business operations, and to take that into consideration in assessing their long-term opportunity set and their financial performance. We look at sustainability to this point about the trade-off between near-term and long-term, or unwinding long-term practices. We're looking at sustainability from the perspective of a long-term investor. 2/3 of our clients are saving for long-term goals such as retirement, and we presume that all of our clients have some long-term lens into what they are doing through their investment strategies and the goals that they are saving for. And that is important because it is over the long term that the material, environmental, and social factors in a company's business play out either to the positive or sometimes to the negative. So we're trying to understand how executive management in particular are building a sustainable business model, are looking at generating long-term sustainable returns that our clients depend on, and how they're ensuring they really understand what's material in their business model, given that our understanding of materiality is dynamic. It is changing over time as we're getting better understanding, particularly of sustainability factors. And in many ways, the framing we use for those conversations that we have with management are very consistent with the framework of the recommendations of the Task Force on Climate-Related Financial Disclosure. And this is a framework we think actually applies more broadly to sustainability factors. And in essence, that is, how is this risk opportunity governed? As the board, what is the role of management? How is it reflected in the company's long-term strategy, including capital expenditures and planning? How is it taken into consideration in the company's risk management policies and procedures and oversight, which is principally in the board? And then the fourth pillar, what metrics and targets is the company using to ensure that it is making progress on those factors and managing those factors appropriately? So in the round, all this comes into a pretty holistic assessment of where companies are in their business strategy and in the implementation of that strategy to deliver long-term returns. In terms of have we ever walked away from investments because of their sort of sustainability risk profile? Absolutely. That is a decision that both our active credit and active equity analysts make regularly. And it is looking at these factors not as sustainability factors necessarily in their own right, and not as a trade-off on return on investment or other factors that are more traditional in investment decision making, but as additional criteria on which to evaluate a company. And really the thing that has changed in the last 5 years to enable that evaluation to be much more structured and formalized is the availability of data. And I know we're going to get to talk a little bit later about reporting, but there is actually so much data available now on sustainability. The real work is on identifying which are the signals of quality and what is just disclosure. And we can talk about that in a minute. Lynn, you're on
from
mute.
the perspective. Oh. Anything you want to add, Melanie, on that? Thanks, Michelle. Anything you want to add to that, Melanie?
Yeah, I mean, I would just comment, I think Michelle covered it really well, that RBC GAM is very much aligned with BlackRock's philosophy in that if you're looking at these sustainability characteristics, they're really additive. You're not giving up, you're not trading off what you're looking at on the financials, but it's an additional metric that you can use as part of your investment analysis. And hopefully, you know, if we're doing it well, we're doing it right, and we're focusing on the material factors, we can potentially enhance long-term returns because we are looking at these securities more holistically.
Well, I think that's great. Thanks. I don't know, Ravi, if you have anything, but maybe we have anything from your perspective, Ravi? Are you seeing anything from the investor perspective you wanted to add?
No, I think I can cover some in the later questions we have.
Okay, well, that's great. I know I attended a session with Larry Fink speaking the other day, and he said that basically ESG and investing is an issue that he hears about every single day. So I think that's a sign of the fact that it definitely is important from an investor perspective and from a company perspective. So Michelle alluded to the issue of reporting, Melanie. I'm going to turn to that now, and we did have a number of questions relating to that. You know, how do I disclose my ESG policies effectively? What should I consider before I engage an ESG services company? What are the most effective KPIs for ESG? Is there a framework for ESG reporting that you guys think will become the de facto gold standard that people should be aware of as they start down the process? And somebody commented that, look, there's just a myriad of choices these days for companies to consider. So what would be the most ideal standards for a company to adopt? So I think companies are really feeling challenged by all the different things out there and would love some advice from institutional investors on what they think companies should be focusing on.
Yes, absolutely. And thanks very much, Lynn and BLG, for having me here today. I'm really happy to be here talking about this topic, which is a really big one. And I am very sympathetic to companies that are having to grapple with this type of disclosure, with all the different frameworks that are out there today. These are all really great questions. I'm going to unpack it a little bit by starting with the current status of the market, because it is moving very quickly, and how it is today is not how we expect it will remain in the next couple of years. And so I think for companies, the first question that they really need to be thinking about is who's the target market for their disclosure if they're thinking about what framework to use. And there's a couple of ways to think about this. One is your target investors? Or is it all stakeholders? And by all stakeholders, you'd also be including customers and employees. The two leading frameworks, I say leading, I mean, there's many, but the ones that we see quite often are SASB, which is Sustainability Accounting Standards Board, and GRI, the Global Reporting Initiative. Now, SASB is more geared towards investors. SASB looks at the reporting on the ESG metrics and how they tie directly into the financial statements of the companies. And so it's very helpful for institutional investors to look at SASB. I know, RBC GAM, we're big proponents of SASB. We're members there. GRI is a different framework, and it targets a broader group of stakeholders. You're looking at as a company and you want to make sure that you're targeting your employees and your customers, you would do a broader report, and you could use the GRI framework for that particular report. It can be a little bit less useful for investors because it doesn't have that direct tie-in to the financial statements that we'd be looking for. So that's the first area, is to think about who your target market is. And the second area to consider is materiality of the ESG metrics for your company. This relates back to the question on KPIs. What are the important KPIs that we should be thinking about in this space? And a really key point is that not all ESG factors are material for every company. It's not the same list you would use for every company. An example would be if you're a bank, you're really interested in cybersecurity and the cybersecurity policies and procedures you have in place. You're not as interested in your water usage. But if you're a beverage company, on the other hand, of course, you're very concerned in your water usage. That metric is material to your business. Cybersecurity, not so much. And so, that's incredibly important to think about, and that takes away some of the burden on these companies and feeling as though they have to report against an entire list of metrics. You just need to understand what ones are material for your business. And if you are looking for a framework for materiality, I would recommend going to the SASB website, because SASB has a really good materiality map framework. It's right on their website. You can find it. And they do have a number of standards that you can also find on their website that are extremely helpful for companies in framing this. So the other part I would just add, and Michelle already spoke to this, TCFD, the Task Force on Climate-Related Financial Disclosures. That's material for every company. It's, climate is a factor that is affecting every company differently. And so we are always encouraging our investee companies to report these climate risks and opportunities in line with TCFD. So that is another framework that companies should be thinking about. So that's the current state of where things are right now, and a very small, there's a whole number of other reporting frameworks, and we could go down a real path of a lot of alphabet soup there, but those are the overall big ones that we typically see the most. But most recently, IFRS, International Finance Reporting, as you probably know, 144 jurisdictions report against these reporting standards, except US GAAP, but they've announced that they're setting up a sustainability standards board. The proposal was put out last fall, and now they're going to go ahead and do this. The goal is to have a framework for reporting on ESG metrics. And the idea being that the jurisdictions that report against IFRS would bring this, and it would be part of their mandatory reporting. The initial focus of the Sustainability Standards Board will be on climate, but the idea is that it would expand to other ESG metrics after that. So this is this is something also that SASB and TCFD will be helping inform these standards, and it is endorsed by IOSCO. So it's got a lot of traction right now, and that'll be really interesting to see how it develops. But it's still in the early stages, so there's still certainly we need to let this develop and see how it plays out over the next couple of years. So just sort of a quick summary for companies that are struggling with this. Few tips. It doesn't have to be a really lengthy disclosure report. As investors, we don't have time to read really lengthy reports. We just want to hit what is material, what matters to your company. If you're able to show progress year over year on the metrics, that's extremely valuable for us. We can see how you've done, but we also want to know where are your targets? What are your goals? Where would you like to get to, so that we can understand what the future looks like for you? And we are trying to compare companies against their peers, and so that's why this type of consistent disclosure is extremely helpful.
Well, that's great tips indeed. Thanks so much. Any other comments from the panelists on that, on reporting issues? And those were great tips.
Yeah, for sure. I mean, I think one of the most common questions we get asked, particularly in Western Canada from the resource sector, is what standard should we use? And I think what Melanie you said there is great kind of guidance on that. It's interesting because there's a lot of confusion in the marketplace on what we should use, and peer groups is always a great example of how we can look at that. There was a publication in the Financial Post last year talking about a study they had done on what issuers in Canada were using as the reporting frameworks, and GRI was definitely, I think the most used according to that report. But BLG kind of did a review of the resource sector and oil and gas companies in particular, and we noticed that SASB was definitely used quite a bit. TSFD was used considerably more than other Canadian issuers, at least in that Financial Post study, had been using. And I do think the reason for that was, similar to what Melanie you had just said, a need for investment in the energy sector, and the requirement and want to kind of attract that investment and to provide that accountability to investors. So I just wanted to kind of highlight that peer group piece is very important, and not all industries are reporting kind of in the same way and are looking at this a little bit differently. But hopefully, when that IFRS kind of standards come in, it'll be more standardized, I guess, throughout multiple industries, if you will.
Yeah, I'd just like to add a couple of points, if I might. When companies are reporting to GRI, for reasons that Melanie said about the investor backing for SASB, it's incredibly helpful if the company also maps its reporting across to the SASB metrics for its sector. And I just want to echo something Melanie said. The reason that investors have really gotten behind SASB is it's very focused on financial materiality of it. Sustainability factors, and for most sectors there's only about 15 metrics that you need to report under SASB, which makes it a lot more manageable both to report and to use as an investor. And then finally, in terms of how TCFD and SASB fit together, SASB is predominantly the sort of source for what you should put under the metrics pillar of TCFD. So it is there's a lot of compatibility across GRI, TCFD, and SASB, recognizing, as Melanie said, you may be addressing different stakeholders under each of those frameworks.
Great. So we have touched a little bit on this conversation about climate being the key. Climate, I think Melanie mentioned, is relevant for all issuers, and also we know Larry Fink's book is a big focus for sure for BlackRock, and TCFD being relevant in terms of reporting. So let's tackle this climate change piece. And as a resource-based economy, Canada is particularly impacted by investor initiatives in the area of ESG. So we've had a number of questions. Someone asked, do you see investors more interested in building markets for the trading of greenhouse gas offsets or advancing technologies to reduce emissions? Somebody asked if the investors will continue to support energy producers during a transition phase, or will they really look for immediate payoff, or an immediate pivot, I should say. Someone wanted to know if we're seeing a rise in the clean tech sector as a result of some of the ESG investing that's been going on and the focus on it. So, Ravi, what have you been noticing that the impact that ESG investing is having on our Canadian resource issuers, and what are your recommendations, thoughts for our resource development companies? Are the international standards going to work, or do they need to be adapted for our Canadian resource companies? And how, if there is adaptation required, how do companies go about that? Do they work with institutional investors? Do they work with regulators? What are you hearing and thinking? And any comments you might have on the clean tech sector as well.
Yeah, no, I mean, first of all, I think it's quite important to understand that the clean tech sector is definitely seeing quite the rise, especially I think in the last year or so. I remember reading reports 5 years ago talking about how we were lagging quite a bit behind the UK in terms of the sector. I think we're starting to catch up a bit. Right now, there's 850 clean tech companies in Canada. We had 12 companies on the Global Clean Tech 100. There's over 300,000 Canadians employed in the clean tech sector, which is quadrupled since a couple years ago. It's now 3.2% of the Canadian GDP. So there is, quite a rise in that sector, and I think it's all part of the focus on energy transition, and that's kind of where the impact I think is we're seeing on ESG investing in the Canadian resource sector. Previously, I do think a lot of resource companies do a good job in terms of their environmental compliance. Our regulatory regime in Canada is a lot more advanced from an environmental perspective than many across the world. But telling that story, I think, has always been an issue. And we've all seen kind of, Leonardo DiCaprio flying out to the oil sands and saying what he has to say, and not accurately getting the information out there that needs to be out there in terms of, the environmental procedures and processes in place that a lot of these companies do have. But I think we're starting to see that definitely trigger as a focus. And if you're following kind of the oil patch in the last kind of few months, you may have noticed that there's been a lot of consolidation, a lot of large mergers and acquisitions, and almost every one of those, as a key point of that deal was to try to tell the story of how that merger would create a stronger company from an environmental perspective, but also from even a social governance perspective. Yesterday I saw an article where Gibson Energy and Enerplus had announced that they're now tying in social and governance factors into their credit facilities. So if they don't reduce emissions by a certain percentage, or if they're not able to add a certain amount of women or visible minorities to leadership positions, they're actually going to have effects on their basis points that they would actually increase under their credit facility. So I thought that was a really interesting way to really kind of tie yourself to, the importance of ESG. So I guess, we've seen a lot of companies, I think, trying to build strongly due to the intense scrutiny over the last few years. And from an advice standpoint or a recommendation standpoint, I mean, what we see as companies that are being successful are the ones that are able to kind of enunciate a clear strategy and really to show the public that, hey, we're not just ticking off a box by doing some sort of sustainability report, really kind of thinking through which report is best for you, which report will not only track but help you kind of tell that story that management of the company really gets how important this is and how it builds into a long-term successful company.
Any other thoughts on the resource industry from the institutional investor side?
I can just add to that, because I think that was a great overview. That from our perspective at GAM, at RBC GAM, we're not interested in divesting from the sector. We think fossil fuels will be a big part of the energy equation for at least the next 10 years. I think that there is, and I would echo Ravi's point, that there's a real opportunity for some of these companies to step up a little bit on the disclosure and what their strategy is, because so many of the clean tech innovations that we're seeing are coming from that sector. That's where there's expertise. That's where the engineers and scientists are working. And so having that and understanding what these companies are doing and how they're thinking about that is really important for institutional investors. And it's also important, as institutional investors, we also have clients that we need to talk to and explain to them what our philosophy and our view is on these. And so having that level of information makes it, it makes it easier for us too to convey that and be able to articulate why we think that this continues to be a good investment. And having said that, I will say, we do have funds and products out there for clients who are interested in divesting, and if that's something they want to do, that's entirely up to the client. But it is our overall philosophy that this is part of the economy in Canada. This is part of the picture, and we need to work towards a just transition together. And so that disclosure and working together with the companies is just really important.
Yes, and I would just echo that in terms of BlackRock's perspective. We definitely see the energy transition as an opportunity, both for energy companies today and for others. And the key thing from our perspective is seeing the innovation by companies to realize that transition in a way that not only protects jobs, but actually adds jobs to the economy. And we think that that is a very realistic expectation.
That's great. We've talked a little bit about the E. We did have some questions, Michelle, from people who are really struggling with S. And, what is S? How do we disclose it? How could we improve our disclosure on this? So I'm just wondering if you have any thoughts for companies that are really trying to wrestle with the S component of ESG. And is that a critical component? Like, we heard maybe you don't have to pick all the factors. So I don't know what you're seeing on S.
Well, it's a little bit, again, Lynn, this thing of sometimes the language is the stumbling block, not the actions that are happening in reality. Another way of framing the S, in our view, is company impacts on people. And so for most companies, the sort of biggest S component is going to be their role as employers and how they're ensuring that they understand the expectations and the needs of their employees, that they're attracting the employees they need to have a successful business, that they're developing those people and ensuring that they're positioning the company to have the workforce it needs in the future. How it's ensuring its workforce reflects the community from which the people are being drawn. So how is the company thinking about diversity, equity, and inclusion, and ensuring that's a reality for the people who come to work every day? Another employment-related component is pay and benefits, and in particular, for many companies, are they paying a living wage? Which I think is increasingly a focus coming out of COVID and some of the social and racial inequity in society that COVID just brought even more to the fore. Then moving away from employees, looking at company impacts in the communities in which they're present, and do they have a positive presence, because that in turn supports its reputation and the perceptions of the company has amongst the communities on which it depends. Then for many companies, there's an S component about their supply chain and how they're ensuring that the businesses in their supply chain have good business practices that, again, would not, you're not running the risk of that reflecting badly on the company. One component of that is increasingly important, both in terms of the company's own direct operations, but for many, many companies more through supply chain, is human rights, and how companies are ensuring that the business practices of their suppliers and their own practices are observing the international norms on human rights, and particularly the rights of Indigenous peoples. And then, of course, customers, another important people group that many companies, are actively mindful of in their day-to-day business, but that if you're thinking about S, is possibly one of the constituencies under that banner. And then finally, sort of under the other category of S, we often see companies talk about their business practices and how they ensure that they have ethical or responsible business practices. So how they're preventing bribery and corruption, for instance. Then for many companies, particularly regulated industries, how they're ensuring they have the relationship with their regulator that supports their business. And then a couple of others that are increasingly part of the conversation in some sectors is responsible tax policies and responsible marketing policies. One final point I think is worth making in terms of ensuring that your investors understand from what the company thinks are its impacts on people or its priority S issues. We believe it's important that companies disclose who they think are their key stakeholders. and how they understand their stakeholders and their stakeholder expectations of the company, and then report to ensure that those practices are understood externally to the company.
Great, that's very helpful. Any other thoughts from the panelists on the S in ESG, or tips for companies struggling with that?
Yeah, I know. I think that was great summary. I think one thing that we are trying to focus on in Western Canada and the resource sector in particularly is Indigenous engagement, for sure, and that being a very strong S factor, if you will. You know, you've seen projects that have obviously been delayed or terminated due to, you know, what I would say is sometimes forgetting the importance of that factor. And so, you know, as a group, and I think as an industry, that's just something that we're trying to highlight more and start thinking about, and having proper policies in place to make sure that we're in communities in the manner possible.
Yeah, and I would just add that, you know, these S factors, it's been really interesting over the past year with the pandemic, because these have come to the forefront like never before. And this is what, when we're engaging with companies, we've been talking a lot about these and getting a lot more information. And I think it's been really great to see the enhanced disclosure that many companies are making around these, and how policies and procedures are being enhanced and disclosed to investors. So I think there's been a lot of movement on the S factor for certainly.
Well, we are the largest law firm in Canada, so we can't not touch on regulation in the area of ESG. That's where we have particular strengths here at BLG, and people are definitely confused about that. So we've had questions about, is there you know, a set of international standards that exist, and what world entities should be responsible for developing those? And that's on the sort of more global side. And then within Canada, we have a small number of specifically focused ESG regulations compared to other countries. So people are asking, are there things that are coming up in Canada? Someone thought, you know, shouldn't there be rules on reporting standards to create a level playing field? Is it time that we should have mandatory ESG disclosure requirements in Canada in line with the TCFD that we spoke about earlier? So where do you see regulation? I'll leave Melanie, Michelle out of this. Well, you're welcome to comment, but I'll focus more on our Canadian panelists for this one, and turn it over to you, Melanie.
Yes, and I mentioned earlier about IFRS. We're setting up a sustainability standards board, which will result in more standardized reporting of ESG metrics. And this, you know, hopefully will be brought in to all the jurisdictions that report against IFRS. So I think that's probably the leading global, you know, group where we're seeing a lot of movement happening right now. And this certainly would be positive in terms of leveling the playing field for companies and for investors, getting the information that they need to be able to make their decisions. In terms of ESG regulations, Europe is leading the charge right now. There are, you know, some overall European regulations. There's also some country-specific regulations. We often see France and Belgium, you know, having the most prescriptive regulations in place. Some of them are mandatory. Some of them are making TCFD reporting mandatory. You know, and so that's something that we're certainly seeing. RBC GAM released its first TCFD report in early April. I know BlackRock also has a TCFD report out there, because this is not just mandatory for companies, but it's increasingly becoming important for asset owners and asset managers to be disclosing their climate risks and opportunities in the portfolios that they manage. So what is our, you know, for example, what are our GHG emissions across our portfolio? So that's what it looks like from an asset manager. So, you know, I think this is growing, certainly growing space for not just companies, but also investors. In Europe, a lot of these regulations are really focused on outcomes. So how are the activities of your company contributing to certain E&S goals, sustainability characteristics? What are the impacts? You know, and for example, how do they line up with the United Nations Sustainable Development Goals, for example, no poverty, zero hunger, gender equality? And so there's a lot of focus on what is the impact of what you're doing as a company, as an investor. Speaking specifically, Lynn, you mentioned, Canada and what's happening in Canada. We did see last summer the Task Force to Modernize the Capital Markets in Ontario recommended in its draft last summer both mandatory TCFD reporting for issuers with a phased-in approach, but they also last summer recommended SASB reporting. In the final document, SASB was removed from the proposed recommendations, but TCFD was still included there, just in recognition of the importance of climate change risks and opportunities. So I think that's certainly one to look out for in Canada as something that's in the pipeline for companies to be reporting against. In addition to climate, another important area where we're seeing a lot of regulation is in the area of diversity and inclusion. Right now, focusing on disclosure as opposed to metrics and targets in place. And Canadian federally regulated companies do have board disclosure requirements right now, but I think this is an area that we're going to see a lot of movement, in terms of disclosure more generally, but also I think down the road we might start to see some targets and metrics put in place as well. So I think that's a really interesting area to watch. In the US, we probably will see a lot of movement under this, and NASDAQ proposed a diversity disclosure rule on a comply or explain basis, which means you comply or you explain why you did not comply, which is still currently under review by the SEC, but just a demonstration that there is a lot of movement and activity in that space. And I'm sure Ravi's got a lot more to add on the regulatory side.
Yeah, no, sure. I mean, you've kind of covered a lot that I was planning to say anyways, but I mean, where I see ESG regulation going, I mean, the question was, is it going to be driven by investment dollars? I think the investment community, from what we are seeing, is the one that is driving the standardization and the request for more of a level playing field. And I think the issuers are understanding that, hey, we've got to kind of come up with a reporting standard that would help us play on a level a lot of these companies. Capital and is increasingly becoming global. So, the idea of potentially having something that's standardized, I think could only help companies and issuers depending on who they are. And traditionally, I think in Canada, our regulatory regime has been, decently robust, but there's not anything, I would say, that has been standardized from all kind of levels of the E and the S and the G. Like for many years, we've had, strong corporate governance kind of disclosure regime. There's a environmental regulatory regime as well. Government is always trying to increase their engagement with Indigenous groups through the duty to consult, and that's kind of being hopefully legislated and improving through legislation that is kind of being passed recently to align with the United Nations Declaration of Rights of Indigenous Folk. From a disclosure standpoint, securities law drives the disclosure for many companies. And so if you're a private company, you may not be subject to it, but for public companies reporting issues, you are. And so I think what we're seeing is securities commissions starting to think about how they are going to kind of pull some of these factors in other than governance disclosure, which has already been pretty, I think, strong and robust over the last how many years. And a part of that is the TSX, for example, released an updated version of their primer for environmental and social disclosure, I think it was last year, which provides updates on their timely disclosure policies, but they're now talking to issuers about how they can enhance their ESG disclosure as well. So I think in the next few years, you can definitely expect both the securities commissions and the stock exchanges to start weighing into these issues more in terms of establishing more of a disclosure regime than there is currently.
Thanks to you both. I know that even on the investment management side, we've been seeing there's no real ESG regulation on asset managers, portfolio managers, but we're starting to see the regulators coming out with audits, and they're focusing on more general provisions like, you can't have misleading communications, etc., to really focus on the issue of ESG. So I think even if there might not be specific regulations, increasingly we're seeing regulators look to other more general provisions to start to look at this area because it's becoming so important. Ravi, you just touched on private companies, and that's reminding me that we did have a couple of questions on private companies. So this session was really meant to focus on the institutional investors who I always think are buying public companies. But someone asked us to comment on the uptake of ESG principles of public compared to private, and what are important ESG fundamentals that nonprofits and private companies should prioritize in order to keep in line with the public or consumer expectations. So any thoughts on that one?
Yeah, no, for sure. I mean, it's interesting, right? Because the disclosure regime in Canada is related to public companies. And so if you're a private company, you often don't even have a platform to disclose. You're not filing things on CDAR, or, your press releases may not be going to the same group of people. So it's a little bit of a different regime. But what we're seeing is a lot of private companies approaching us and talking about trying to put in some governance frameworks, trying to put in some social and diversity policies, having environmental policies, and really kind of trying to hit some of these ESG fundamentals that we've been talking about throughout the session. And I think that's actually been driven by venture capital and private equity. And so I find that a lot of private equity companies in particular have very robust ESG requirements when they're making their investments. And I'm sure everybody on here can talk to that as well, but that in turn results in private companies needing to make sure that they're attractive to those investments. So we need to make sure that they have proper independence requirements, which would be important if you're going public, or if you are going to be looking at some sort of liquidity event. Many of them are trying to strengthen their social governance policies and having more diverse boards and leaderships positions, because they believe that'll make them more attractive to investment. And environmental, of course, is going to be a large risk, going forward, and it's something that private equity and venture capital investors are really looking at when they do due diligence. And I think it's interesting, though, the way companies are doing due diligence on their potential investments or acquisitions is starting to focus more and more on ESG factors. I thought environmental was always something that people were looking at, but you're finding people to ask different questions around that, and very interesting questions around some of these social aspects when you're doing due diligence sessions or management meetings. So the way we're seeing it, I do think that private companies are more and more becoming focused on this, and I think they need to if they're going to be looking to attract investment or exit opportunities.
Any other thoughts from the panelists for private companies or charities? No.
One thing I'd add that I do think is going to be an important driver for private companies is the increasing requirement by anyone who wants to use you as a contractor or a supplier, that they put out vendors sort of surveys now, when you have to demonstrate many of the points that Ravi made around a diverse workforce and responsible business practices in terms of your environmental and social impacts. So I think there's just getting to be inquiry about companies' practices from many different angles now that will, I think, influence outcomes.
Yeah, great. Well, while we're having you there, Michelle, you were so good on taking us through the S. We're going to pick on you for the G, starting us off on the G discussion as well. So we did have a number of questions on G, and some are more specifically on the G from an investment perspective, but some are more process Gs. I know we do spend a lot of time doing training sessions for boards and others, but so I kind of grouped them all, even though they don't quite go together, but let's do it this way. So someone commented that it's easy to convince senior management to take action when there are government mandated requirements, but in the absence of this in the area of ESG, how can a company get management buy-in for ESG? Somebody, and this is very relevant, I think, for RBC, but somebody saw an increasing trend to linking executive compensation to ESG criteria. How important is that point going to become to institutional investors? And somebody just asked, what are some of the key barriers that you think companies are resistant to adopting ESG metrics? What do you think some of the key barriers are that companies are experiencing? So any thoughts on that to start us off on the G discussion, Michelle?
Sure. So I think the G part, if anything, is the more important part, because in our experience, without good governance practices, a lot of the implementation of environmental and social business policies are not necessarily going to have the desired effect. We are looking increasingly to boards to demonstrate that they are taking an active role in overseeing management's approach to sustainability in the company's business model. And I think, again, the language can be a problem here because we're talking about sustainability and ESG as if this wasn't part of how the company is run. And if you're focused on the material E&S issues in a company's business, they are part of the day-to-day operation of the business, and they should also be part of the long-term strategy planning and the risk monitoring and assessment models. So I think it's about the framing of it. One of the things that we also expect to see is an articulation of the governance of sustainability issues within a company, whether it is devolved out to businesses, whether there is somebody in the C-suite or the next tier down who coordinates across the firm to make sure that sustainability is being fully integrated. And I think, maybe an example here is valuable because it's a little nebulous, but if your business model is, or your operating model is dependent on water, your sustainability risk around water is an existential business risk. It isn't sustainability for water for its own sake. It's if you can't get access to water or other natural resources, then your business model is in jeopardy. And those are the ESG factors that we want to understand, because that's how you assess a company's risk and opportunity set.
Right. Any other thoughts on governance issues?
I would just maybe add, there was one question in there about linking executive compensation to ESG criteria. And just from, every year we have a say on pay vote as investors in the companies. And when we're looking at, ESG criteria and exec comp, we do like there to be some tie-in. We do like executives to be paid and be penalized, and based on the performance and how they're doing in this area. There is one caution, though, something that we're a little bit wary of, is that we do want specific metrics in this area to be set out, because the concern is that then it just becomes a way to easily add extra compensation without tying it directly to ESG metrics. So that's something that we are looking for when we assess these executive compensation structures every year.
Yeah, and I'd just like to build on that one little point. A conversation we've had with a number of comp committee chairs around the sustainability performance criteria in pay plans is, because some of this is very new, it's actually requiring a fair bit of modeling to work out what are truly stretching targets. And to Melanie's point about we don't want to see this as sort of something that is being gamed, I think there will be a fair amount of scrutiny as to the extent to which environmental or social criteria are truly stretching and are truly strategic.
Great.
Yeah, I just wanted to comment on one question here that Lynn, you raised, and it's just about the barriers that companies are seeing when it comes to reporting or following ESG metrics. And I think that's an important topic. It's one that we are asked all the time. Companies look at the Suncors of the world and say, how can we do that, right? And I think you need to be reasonable in terms of your resources and your ability to actually meet these ESG metrics. And so, I mean, a lot of companies are stressed out, frankly, that they're not going to be able to attract the BlackRocks of this world because they're not maybe disclosing things or following those type of ESG metrics to the extent that other large companies have. I think the one thing companies need to understand is a lot of these metrics are very simple, I think, and easy to hit if you just put some time and effort into it, and they were not going to cost you a lot of money. Like proper corporate governance policies are, not difficult to put in place, and to have like policies on social issues and diversity. Those are things that if you are willing to do that, it's not going to cost you a ton of money. And so I think you can start focusing on those things at an early stage and understanding how to put those in place. I think it goes a long way with the investment community. I don't think everybody's saying ESG is the end of everything if you don't report or do everything properly. Like return on investment is obviously a very important piece of this as well, but we have to understand that that does tie in, right? And so having strong governance and social factors, easy enough to do, helps build a long-term viable company, and something that I think everybody should think about.
That's great. Well, we only have about 5 minutes left, and somebody mentioned the word gaming, and the word greenwashing also comes to mind. So what mechanisms do institutional investors have in place to increase accountability for ESG factors? You know, it's not like when we're back in school and there were tests, but maybe there are. So how are you monitoring and assessing the companies you're invested in, Melanie?
Yeah, and just the term greenwashing, just for, I'm sure everybody knows what it means, but if you don't, it just means that you say you're doing something on ESG and in particular on the E side, and you're not. And so as investors, really the only way to get to the bottom of this is with more information. I think there are two parts to the question here. I know the question specifically focuses on how investors are looking at investing in companies, but there's also a question about investors and how we integrate ESG and ensuring that we are not participating in any greenwashing. So on the first question, how we look at our investee companies, it's all about knowing what they're doing. It's all about disclosure that they're making. There's a lot of data, and we talked about this earlier, that's available on companies, and we purchased a lot from different vendors, MSCI and Sustainalytics. One thing I will note is we don't rely on the scores of the vendors. So these vendors will have an ESG score for the company. We do look at it, we are aware of it, and we're certainly tracking it. If it changes, we want to understand why that score has changed. But we do our own analysis with the raw data. And so raw data that we're looking at, GHG emissions would be one, tobacco, different things that, we're actually looking at. How, companies' water usage, what does that look like? So we are doing our own analysis on that. And so the data is part of the equation, but also active stewardship. And Michelle spoke to this, much earlier in the hour, but the importance of active stewardship, and at GAM, our investment teams and my team, which is Corporate Governance Responsible Investment Team, are active in meeting with companies and boards, and we discuss these ESG factors. We talk about the company, their strategy, how they're addressing these risks and opportunities. The number of engagements itself depends on the company. In the initial wave of the pandemic, I think our investment teams did more engagements in the first few months than sometimes, in other years, other periods. It was quite incredible because there were so many ESG factors that were in play at that time that as investors, we really needed to understand what the companies were doing. And so it's getting beyond what the company says they're doing and just really, looking at the data, having meetings, developing that relationship with the company to really understand. And a lot of these engagements, we do them collaboratively as well. And that's, there's a number of organizations in Canada that, and I'm sure, if you're in a large company, then you would have, you might have been exposed to Canadian Coalition for Good Governance, which, it participates in engagements on behalf of its institutional investor members, 30% Club Investors Group, Climate Action 100+. These are all groups where investors have an opportunity to come together and leverage their collective power to talk to companies about some of these issues. Just on the second point on greenwashing for asset managers, this is something that, we want to make sure that, whenever accused of greenwashing, we always ensure that we're doing what we say we're doing. And I think that it's just really important for us and for our clients and for the public and companies to just be very transparent in our approach. We put our policies out there, we do our TCFD report, we do our annual reports, we disclose all our proxy voting and our rationales, and we do fulsome client reporting on what we're doing. And we encourage people to ask us, well, what is your process? How are you thinking about this? What do your different investment teams, how are they specifically integrating ESG factors as part of their process? So it really boils down, I think, for both. It's all about disclosure, transparency, and talking about this, because it can be challenging otherwise to just, there's no box that we're checking to say, yes, we have met all the requirements in this area. It's all about just really information, getting it out there.
I don't know, Michelle, if you want to add, we have about just 1 minute if you had anything you wanted to add to that discussion. But
I would just make the note, it sounds a little ominous, but there is a lot of scrutiny of companies and of investors, to Melanie's point, about what they're doing on sustainability. So I think it's really behoven on companies to tell their best story through their own disclosures, and make sure that you're being representative of the reality, but also know that as investors, we get approached from a lot of different angles, with people who believe they have an inside track on what companies are doing. And I think there's endless research and endless sort of data sources and so on, which may be telling the story differently to how you'd like to see it told.
Well, great, Deb. Well, thank you very much for joining us today on the panel. Ravi and I just really want to thank you, Michelle and Melanie. I thought it was a great discussion, and I'm sure our clients found it so helpful. And I just, please, if you need any help with your ESG strategies or training, just reach out to us. BLG has just released its new ESG website with our thought leadership there as well. And just want to thank everyone for joining today, and especially Ravi and I want to thank you, Melanie, and you, Michelle, for all that so helpful insights for our clients. Thank you, everyone. Have a nice day.
Thank you.